Do you remember when the global economy felt like a jet engine? Loud, fast, and almost unstoppable? Well, not anymore. According to the June 2025 Economic Outlook released by the OECD, the Organization for Economic Cooperation and Development, the world economy is now running on far less power than it was just a year ago. Now, if you're wondering what the OECD is and why you should care, let me explain. The OECD is a group of 38 of the world's most advanced economies, including the United States, Japan, Germany, France, and others. India is not a member, but it has been an OECD key partner since 2007. That means India actively collaborates with the OECD on research, policy benchmarking, and economic reform discussions. The OECD is one of the most credible and widely respected global institutions for economic data, policy guidance, and forecasts. Its reports are closely followed by central banks, governments, global investors, and multinational corporations. In other words, when the OECD raises red flags about global growth, smart professionals take notice. Global GDP growth, which stood at 3.3% in 2024, is projected to fall to just 2.9% in 2025 and remain there through 2026. That might sound like a small drop, but in economic terms, it is a clear signal of cooling engines, weaker demand, and rising friction across the entire system. Welcome to Demystify Finance. In this video, we are going to break down exactly why the global growth engine is stalling and what this means for finance professionals. Whether you are in asset management, credit, macro strategy, or corporate planning, this is for you. And if you're new here, hit subscribe and like this video so you do not miss deep, researched insights like this. Let us get started. Let us begin with a global picture. Across advanced economies, growth is moderating. The United States, which grew at 2.8% last year, is now projected to grow at only 1.6% in 2025 and even lower in 2026. Europe is not doing much better. The euro area is expected to grow at just 1% this year. Even Japan, which saw a rebound last year, is slowing back down. But here is the twist. It is not a synchronized slowdown. India, for example, is expected to grow at over 6%. That is 3 times faster than most advanced economies. China too, while slowing, is still growing at 4.7%. So we are entering a world where global growth is no longer driven by a broad engine. Instead, it is fueled by a few scattered sparks. Let us unpack why this is happening. First, trade policy is now acting as a brake rather than a boost. The return of tariffs, especially between the United States and China, is raising prices and reducing trade flows. OECD data shows that over 2% of world GDP is directly impacted by these trade tensions. That is a big deal. Second, uncertainty is through the roof. When businesses and consumers are unsure about where the world is heading, whether in interest rates, energy policy, or geopolitics, they delay decisions. Investment gets frozen, hiring slows down, demand weakens. Third, financial conditions are tightening. The OECD notes that while central banks have started cutting interest rates in some regions, real borrowing costs remain high in many places. This is squeezing both consumer spending and corporate credit growth. And finally, public debt is weighing on growth. Governments are more constrained than before. With rising interest payments and fiscal fatigue, they cannot always step in with big stimulus packages like they did during the pandemic. Now, what does all of this mean for you? Let us bring it home. If you are in corporate finance or strategic planning, slower global growth means lower revenue assumptions, higher financing risks, and more conservative investment hurdles. You cannot assume the rising tide will lift your business. If you are in asset management, this means you will need to shift your portfolio allocations. Global equity returns may underperform in developed markets, while emerging markets like India, Indonesia, and parts of Latin America could offer better growth exposure if you can manage the volatility. If you're in credit, lower growth and higher debt mean you must stress test your exposures more rigorously. The OECD expects fiscal risks to rise in both advanced and emerging economies. Default probabilities will rise, especially for sovereigns and high-yield corporates. And if you work in macro policy or research, now is the time to focus on structural issues. The slowdown is not just cyclical. It is being driven by underlying inefficiencies such as low investment, trade fragmentation, and policy uncertainty. So where does the opportunity lie? The OECD outlines several areas where growth can be revived. First, through coordinated trade reform. Removing barriers, especially in services and digital trade, could reduce costs and boost productivity. Second, investment in green and digital infrastructure. Governments that can prioritize these areas while maintaining fiscal sustainability could see strong medium-term returns. Third, labor market reform. In many countries, especially in Europe and Japan, the working age population is shrinking. Improving participation and productivity is critical. And finally, clear and credible policy communication. Markets hate surprises. When governments outline a steady, rule-based framework, whether for taxes, interest rates, or regulation, it builds confidence. So here is the bottom line. The global growth engine is not dead, but it is sputtering. Unless we upgrade it with the right fuel and the right policies, financial professionals will be navigating more turbulence ahead. Understanding where growth is going, what is holding it back, and how to adapt your strategy accordingly is what will set you apart. If this video helped clarify where we are heading, do me a favor. Like this video, subscribe to Demystify Finance, and comment below with the one country or sector you think will defy the global slowdown and why. I will feature the best responses in the next video. Until then, stay curious, stay sharp, and keep asking the questions that matter. This is Demystify Finance, signing off.